Wow, global head fixed income strategy. So $17 trillion roughly in sovereign debt with negative yields. How do you have an investment strategy when much of the world's debt is yielding exactly zero or less than zero?
Yeah, it's come back a little bit. So it was 17. It's roughly 15 now.
Yeah.
But you're right.
It's
It's
a
a
lot.
large number.
It's a lot.
A large number of negative yielding debt. It's challenging right now. And I think right now you want to be a little bit more balanced in your approach. Right now, you don't want to take the way you get paid is for taking risk. And the risk that you want to take in this market, we think, is a little bit lower than what you normally take, meaning that your interest rate risk, we'd probably neutralize duration, neutralize your yield curve exposure, but look towards sector exposures. There are some pretty attractive sectors, we think, in the markets. Mortgage backs, preferreds, just to name a couple, and we actually think munis still offer some opportunities.
Even, at a couple percent. I mean, that's basically what you need to be happy with these days, right? As a fixed income
and you
person.
have to. It's all
3% sounds like the new 8%. You know what I mean?
It's relative, right? It's all relative to what else can you do, right? So the idea of the mortgage backs, right now you can get mortgage backs at roughly 90% of the yield of corporates, yet you only have about a third of the risk, right? So from a risk-reward perspective, they look pretty attractive. Why is that the case? Well, the Fed's made it clear that they're kind of cleaning up their balance sheet a little bit and probably selling some mortgage-backed securities as a result of that. So they've backed up a little bit. They've underperformed. That's the time you want to step in.
Okay, yeah. And what's the risk to fixed income markets? I mean, there seems to be this, we had this repo thing the other day, which is a little bit esoteric, but obviously important. It feels like there's a shock risk to the system that maybe we're not talking enough about.
Well, I don't know if there's necessarily a shock risk out there. We do think that you've seen, and even Chairman Powell mentioned this yesterday in his testimony, there has been a buildup of credit, pretty significantly so, in the corporate bond market. And that I thought he made a good point, though, was the idea that this would potentially exacerbate downside risk when a downside potentially occurs, not necessarily cause it. So that's something to be aware of and concerned with. But we don't necessarily think there's going to be a large, significant spike in rates simply because we are in a global economy right now.
Yeah.
And when you look at global rates and you look at the alternatives, it's all pretty much lower. Our base case is actually that rates potentially keep going down from here.
And the U.S. will continue to look, I assume, more attractive than the rest of the world.
It certainly does. When you're looking at, zero and negative rates overseas, it looks fairly attractive here.
Yeah, and do you trust the Fed? Do you think they're doing a good job?
I thought they did a very good job yesterday. I think he had a challenging situation. Look, he's dealing with, risks and pushbacks from whether it's internally his own team, whether it's the markets, whether it's the president. And I think he handled that fairly well to deliver a balanced message, a message that cut rates, but also said, hey, look, going forward, we might not be cutting rates.
All right, well, I hope he's watching because he's been taking some heat. So George Rusnak giving him a little compliment there, and we appreciate it. Good morning, George. Thank you very much.